Hi everyone, today we're going to look at the stock of the video game company Take-Two Interactive. Ticker is TTWO. I think when people traditionally think of video game stocks, they look at Activision, EA, and maybe Zynga. And Take-Two is one that often gets overlooked because it's not as well known. So today in this video, we're going to kind of dive a little bit deeper into the company. And as usual, everything I say is my opinion and not investment advice. So Take-Two was trading at $174 a share, which equates to about a $16.8 billion enterprise value. It is trading near its 52-week high, but not quite there. Definitely way above their 52-week low, which I'm guessing happened back in March. So a little bit about what they do. It was founded in 1993 by Ryan Brandt. I think he actually passed away recently in 2019. The company is based in New York. They're really known for the two big game studios, Rockstar and 2K. So Rockstar has made some very well-known games like Grand Theft Auto, Red Dead Redemption, and 1 and 2, and Max Payne. 2K has made games like Borderlands, BioShock. They make a lot of they make these sports games like really NBA 2K, as well as like 2K Golf. And I think they're actually gonna start making like an NFL 2K game as well. So XCOM. I forgot to mention XCOM, which is also very well known. They have two smaller game publishers, Private Division, which makes Kerbal Space Program, and then they have Social Point, which makes Dragon City, Monster Legends. These are like mobile games, and I don't play them, so I've never heard of them. But the rest I've definitely heard of. And so, as you expect with these like game studios, their top hits kind of account for a big part of their revenue. So GTA, Grand Theft Auto, accounts for 23% of revenue. In fact, their top 5 games account for about 87% of revenue. Some recent news: they recently acquired a game studio called Codemasters, which makes F1 Formula 1 racing games. So they just acquired that company. So moving on to a little bit about some of the positives and investment thesis for this company. So I think as someone who like grew up playing video games, Take-Two games are really known for their solid and really great storytelling. So if I were to like make a kind of a movie analogy, if Call of Duty, which is made by Activision, and like Battlefield, made by EA, these are games that like come out every year and they're kind of blockbusters. If those are like kind of the blockbuster Marvel movies, then Take-Two games are more like Inception or like Fight Club. They're more almost like independent, but movies that may not have as much of a mass appeal, but the people who love them really love them because they're great movies with great storytelling and writing, and that's exactly what kind of Take-Two is known for. In fact, if you like Google video games with best storytelling, you'll see that kind of consistently BioShock is up there, Red Dead is up there, like even GTA has really good writing in the game. So I think that's a differentiator for this company relative to some of like the bigger studios, because I mean, we don't want to always watch Marvel movies all the time, right? Just like you don't want to play those types of games all the time. Secondly, I think this will benefit everyone, but we recently had a hardware refresh in the gaming console. So the new PS5 is out, the new Xbox is out right before the holidays, and obviously that's a positive for the gaming for these gaming studios, because like whenever there's a new hardware out, like remember like the PS1 or PS2, that usually ushers in an era of like game publishers just publishing new games for these new consoles, because now the specs on the hardware allows them to, make much better, much more visually appealing and, better games. And that's happened with like PS1, PS2, PS3, like Sega, like every single generation of console kind of ushers in a new era of development, right? And also on top of that, the pandemic and the stay at home is obviously positive as well. Now, I always like to look at the core fundamentals of companies. So this is no different. Now, this is something interesting about Take-Two is if you look at their PE ratio and you see it's like 42, and you might be thinking to yourself, that's really high. But PE in this situation doesn't really tell you the real story. Because on a free cash flow basis, Take-Two is pretty cheap. It's only trading at about 19 times. And what's the big difference between the PE and the free cash flow? Obviously, free cash flow is what you care about, right? And the difference is that if you think about a company, a video game publisher, they don't have to buy a lot of equipment. They're kind of an asset-light business. So their CapEx is quite low relative to their depreciation, which is a non-cash expense. They depreciate some of their like software development costs. So their depreciation, which is an add back, is much higher than their CapEx, which means that they're always getting a positive cash flow from the depreciation add back, right? Secondly, the working capital. This company, as it's growing, it's generating a positive trend in working capital, as in they're receiving money faster than they have to pay like suppliers, and that's good because you want a business as it grows. It's not like eating up cash; it's like generating cash, right? It's not like eating up working capital. It's creating working capital. So Take-Two's working capital combined with their low capex and their high depreciation add back creates a free cash flow that is much higher than their net income, right? And so that's why they're only trading at, realistically on a cash flow basis, they're only trading at 19 times. Now let's look at that relative to some of their peers. So Activision, EA are trading at about 28 times. Zynga is about 25. So the other companies are obviously more expensive than Take-Two. And I kind of thought about why. And number one, I think they're more well known, and they're larger. They're much larger. Like EA is 58. Activision are about like $60 billion companies. Take-Two is a third the size of those two. And maybe there's some, size premium because the larger companies are able to survive a more severe downturn. But Take-Two has a rock solid balance sheet. It has no debt, has $3 billion of just cash on hand. Very healthy balance sheet. And honestly, I can't figure out a good reason why they're cheap relative to the competitors. And yeah. And I think like, so lastly, if you look at some of the risk factors of why they're not trading at the same valuation, is maybe they don't have as many games. They don't have like a big presence in mobile games. So I Google like the top mobile games out there. I mean, none of Take-Two games even make this list. You have some in the video game industry in general. You have kind of what's called keyman risk, where if I remember back when Blizzard made really great video games, and then a lot of the key people who made those games like left or retired, and then the whole like studio kind of, the quality like went down significantly. It's not the same as before. So you have keyman risk, especially pronounced in this type of industry. Also, they're dependent on the success of just a few games like GTA, Red Dead, NBA 2K, right? We already talked about how the 5 bestsellers are like 87% of their revenue. So to the extent that one of these top sellers, these top hits, become unpopular in the future, then you have to find a new hit to replace that, to make up for the revenue. And maybe it's tough to do. Like, but you can say the same thing about EA or Activision. Like, they're heavily dependent on Call of Duty and, you know, Battlefield. So to the extent that these games don't have permanent staying power, you have to find new hits to replace them. So yeah. So I think overall, Take-Two is definitely something worth looking at if you're interested in the investment in public video game companies, right? Because relative to their peers, they're cheap. Relative to the market, remember the S&P has like a P of like 30 times. So this is cheap relative to the market, relative to the peers. Has very strong balance sheet. I mean, the only kind of thing you kind of want to consider is whether you like the types of games that they've published, whether you fundamentally like the products that they make. And for me, that's like a check mark for yes, but it's not for everybody, right? So yeah, let me know what your thoughts are. And as always, thanks for watching.